Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
So, Janine, it looks like Canada's housing crisis isn't going to ease up anytime soon. Recent forecasts suggest that the number of housing starts is expected to decrease this year and next, which contradicts the political promises we've been hearing about increasing the housing supply.
That's right, Steve. The Canada Mortgage and Housing Corporation, or CMHC, is predicting that housing starts will drop to about 237,800 this year, down from 245,367 in 2024. They're also forecasting a further decline to 227,734 next year and 220,016 in 2027. That's quite concerning, given the demand for housing across the country.
It is concerning, especially when you consider that the CMHC says we need to add 480,000 homes each year over the next decade to meet demand. The drop in housing starts is particularly noticeable in British Columbia and Ontario, with decreases of 8% and 25% respectively. These are areas already struggling with high housing prices in cities like Vancouver and Toronto.
Absolutely, Steve. Affordability is a major issue, and with new construction slowing down, it's not helping the situation. Economists point out that more builds would not only provide homes, but also help bring down prices by increasing supply. Plus, it would stimulate economic activity and create jobs.
Right. And let's not forget the financial implications for governments. More construction means more tax revenue from housing developments, which is crucial for municipal, provincial, and federal budgets. Yet, we're seeing a lack of progress despite the political promises made during the last federal election.
True, Steve. There are numerous factors at play here, like increased interest rates, labor costs, and material prices, not to mention the red tape and taxation that developers face. It's a complex issue that requires a coordinated effort from all levels of government to address effectively.
And let's not forget the lag time in the construction process. It can take over a decade from when land is earmarked for development to when people can move in. This delay is a significant barrier to quickly addressing the housing shortage.
Exactly, Steve. And with some developers sitting on approved land until market conditions improve, it exacerbates the problem. It's a challenging situation, but hopefully with continued dialogue and strategic planning, we can find a way forward.
Janine, have you heard about the new development proposal in Vaughan? It's a massive project that could really change the skyline of the city.
Yes, Steve, I did. It's quite an ambitious plan. The Cortel Group is proposing to build 19 towers on an 11.5-hectare site near Highway 7 and the future Concord Geostation. That's a significant amount of construction.
Absolutely, Janine. This project is part of Vaughan's ongoing transition from low-rise developments to high-rise towers. It's fascinating to see how these changes can redefine a city's landscape. The development is expected to include 10,912 residential units, which is a substantial addition to the housing supply.
It's a huge number, Steve. But while it's impressive, we need to consider the impact on the community. Such a large-scale development might bring challenges, like increased traffic and pressure on local services. On the bright side, it could also mean more jobs and economic activity.
That's a good point, Janine. The location is strategic, being close to a future transit station, which should help alleviate some traffic concerns. Plus, the plan includes green spaces and connections to natural landscapes, which could enhance the quality of life for residents.
I agree, Steve. The integration of green spaces and amenities like a health and wellness center, a daycare, and even a grocery component is thoughtful. These features could make the area more attractive for families and individuals looking for a well-rounded community.
Exactly, Janine. It's important to create a balance between urban development and maintaining a livable environment. The inclusion of amenities could also increase property values and appeal to a broader range of potential buyers.
It's definitely a project that could bring a lot of positive changes. But Steve, what about the potential downsides? Large-scale developments often face opposition from local residents worried about changes to their neighborhoods.
That's true, Janine. It's essential for developers and city planners to engage with the community and address any concerns. Transparency and dialogue are key to ensuring that such projects are beneficial for everyone involved.
Absolutely, Steve. It's about finding a way to grow while still respecting the existing community and environment. With careful planning and community involvement, this development could set a positive example for future projects.
Let's shift gears and talk about Gogama, a small community in rural Ontario that's been facing a unique housing dilemma. Despite having numerous vacant government-owned properties, these homes haven't been listed for sale, leaving both residents and local leaders frustrated.
That's an interesting situation, Steve. Gogama, which is in an unincorporated area, has several surplus homes that could potentially help alleviate some of the housing shortages in the region. But as it stands, none of these properties have been put on the market, which is really unfortunate.
It's definitely a missed opportunity. The properties in question include former Ministry of Natural Resources and Forestry buildings and Ontario Provincial Police residences. France Gelinas, the member of Provincial Parliament for Nickel Belt, has been advocating for their sale for years, but the process seems to be stuck in bureaucratic limbo.
It sounds like a classic case of red tape getting in the way of progress. Infrastructure Ontario is responsible for these properties, and they claim they're still conducting necessary assessments before any sales can proceed. But it's been years, and the community is anxious to see some movement.
Exactly, Janine. And while these properties remain unsold, the government continues to incur maintenance costs. It's a situation that doesn't make financial sense, especially when there are potential buyers interested in purchasing these homes.
Plus, selling these homes could bring new families into the community, which would be a huge benefit. Gogama could use an influx of residents to boost the local economy and support community services. It's clear that there's a lot of potential here, if only these properties were made available.
And let's not forget the historical context. Gogama has a rich history, but its population has dwindled over the years. At its peak in the 1930s, it had more than 2,000 residents, but now it's down to around 330. Putting these homes on the market could help revitalize the area.
You're right, Steve. This isn't just about housing, it's about community development and sustainability. Bringing in new families could mean more volunteers for local initiatives, more kids in schools, and generally a more vibrant community life.
Absolutely. And there's also the issue of how these surplus properties are managed. The Local Services Board in Gogama plays a crucial role in maintaining community services, but they don't have control over the sale of these properties. It's a complex situation that requires coordination between multiple government entities.
It certainly is complex, Steve. But with a concerted effort from all parties involved, including the provincial government, there's hope that Gogama can overcome these challenges and turn its surplus homes into a real asset for the community.
Janine, let's delve into MCAN Financial Group's recent quarterly earnings. Their net income for the second quarter has grown to $20.2 million, which is a slight increase from the $19.7 million they reported the same time last year.
That's interesting, Steve. It sounds like their efforts in expanding loan portfolios and launching a new securitization channel are paying off. I noticed that their earnings per share actually decreased slightly from $0.52 to $0.51, even though their net income rose. What do you think caused that?
Well, Janine, the increase in net income is largely attributed to higher mortgage spread income and increased earnings from their stake in MCAP. However, the slight decrease in earnings per share might be due to higher provisions for credit losses, which rose to $2.2 million from $1.4 million a year ago. This seems to be linked to worsening economic forecasts and some provisioning on impaired residential construction loans.
It's good to see that despite these challenges, Derek Sutherland, the CEO, remains optimistic about their credit quality. He highlighted record originations in their insured residential lending business and emphasized the launch of an uninsured residential mortgage securitization program as a key growth opportunity. It's clear they are strategically navigating the current economic environment.
Absolutely, Janine. Their strategic focus on expanding in Alberta and British Columbia's urban markets shows they're capitalizing on areas with strong housing demand. They originated $231 million in uninsured residential mortgages in the first half of this year, marking a 17% increase from last year.
And with the introduction of the new securitization program, they've already sold $80.2 million in July alone. This diversification and capital optimization could provide a solid foundation for future growth. It's encouraging to see them investing in systems to enhance service for borrowers and brokers as well.
Right, Janine. Sutherland also mentioned maintaining their pipeline for higher yield residential construction and completed inventory loans, particularly in Ontario, British Columbia, and Alberta. These areas are experiencing population growth and a shortage of affordable housing, which drives demand for housing developments.
It's a sensible approach, Steve. By focusing on experienced developers with a successful track record, they can mitigate some of the risks associated with construction loans. Plus, their partnership with MCAP seems to be a key driver of returns, with partnership income rising 3% year over year.
Indeed, Janine. Overall, MCAN's performance this quarter reflects a balanced strategy of growth and careful risk management. As they continue to adapt to market conditions, it'll be interesting to see how their efforts in market expansion and securitization impact their future earnings. Let's talk about the Canadian dollar, which has managed to hold on to a weekly gain despite some softer than expected jobs data. The loonie was trading nearly unchanged at 1.3745 per United States dollar, or 72.75 United States cents, after moving in a range of 1.3726 to 1.3762. For the week, the currency was up 0.3%.
It sounds like the currency market is responding to a mix of factors, Steve. The Canadian economy shed 40,800 jobs in July, which was quite a disappointment compared to the expected gain of 13,500 jobs. This drop sent the employment rate to an 8-month low.
That's a significant change, Janine. Interestingly, despite the job losses, the expectations for interest rate cuts by the Bank of Canada have only shifted slightly. Investors now see a 38% chance of a rate cut by the central bank in September, which is up from 33% before the jobs data was released.
It's a delicate balance, Steve. The strategists at TD Securities mentioned that while the trade deal with the United States remains a looming risk, it may not be a game changer for the economy or the Bank of Canada. After all, 92% of Canadian exports entered the United States market tariff-free in June under the US-Mexico-Canada agreement. That's quite a reassuring statistic for Canadian exporters.
Absolutely, Janine. The fact that the Canadian dollar managed to maintain its weekly gain suggests that the market is still weighing these factors. Meanwhile, Canadian bond yields eased across the curve, with the 10-year yield down 2.5 basis points at 3.377%.
It's also worth noting that the Canadian 10-year yield fell further below the U.S., equivalent widening the gap to about 91 basis points. This divergence could reflect different economic outlooks and monetary policy expectations between the two countries.
Indeed, Janine. With these developments in mind, it's clear that the Canadian dollar and bond markets are navigating a complex landscape. It'll be interesting to see how these dynamics evolve as we get closer to the Bank of Canada's next policy announcement.
Definitely, Steve. As always, staying informed about these market trends is crucial for anyone involved in the real estate and mortgage sectors. The currency and bond markets can have significant impacts on interest rates and, ultimately, on mortgage costs for Canadians.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.